Two of the most popular risk management strategies for cattle are LRP and long put options. A lot of people who have only ever tried put options, but I also know a lot of people who have ever only used LRP. In this video, I'm going to talk about 3 big differences between these 2 different products, and you can see which one seems more right for your operation. So while it is true that long put options are very similar to insurance, LRP is insurance. You're paying premium up front. You're paying premium for that put option, and you're paying premium for that LRP contract. That's true. Your limited risk is that premium up front, and that is the same. But one thing that is different is the put options are tied to the futures board, and the LRP is derived from the feeder cattle index and the 5-weight average if you are talking about fat cattle. Because of this, some people think that the LRP is tied more accurately to cash market. But the truth is that futures are typically swaying in the same sense as the cash market, maybe not so much in everyday short term, but overall the general sway of the market is the same. And the truth is you're only risking the extra basis. We won't get into that in this video, but there are some people who believe more in the futures market, and there's people who believe more in the feeder cattle index or the 5-weight average. The really important thing, I think, is that you dial in and learn how futures work, learn how the 5-weight average works, learn how the feeder cattle index works, and just see how those things fluctuate and see what is more accurate to your operation, to your local market, depending on what you're trying to do with your operation. Number 2 is going to be the flexibility of the put option versus the LRP contract. Now, this can be good or bad. With a put option, you have the flexibility to get out anytime since you put the contract on. So you can buy a put today and get out of it tomorrow. But if you buy an LRP contract, you're locked in until the end of that term. So it's an insurance policy throughout that full term. You cannot change that. A put option, you have the flexibility to collect a quick profit. Now, that might sound good, but for some people, they like that the LRP keeps them honest. You know, you're buying that like car insurance. You don't plan to use it. You're giving up that premium, and you shouldn't really get out of that for a true hedge or true insurance until the end of that policy anyway. But with an LRP contract, that also means that you cannot speculate a little. And some people don't call it that, but that's true. If you put a put option on and then you get out of it maybe a month or 2 ahead, you are speculating the next 2 months that the market is not going to go down and take away that premium or take away that profit that you probably collected if you got out of it. So you have to weigh your pros and cons. Do you want that flexibility, or do you want to stay honest in the true insurance? Now, if you don't understand LRP or futures or options, check out the AgriSummit community. It's an online community I created to start putting out educational content on topics like this, and to bring a community of like-minded ranchers, cattle feeders, the family operations together so that we can help each other succeed and become more profitable and be able to pass on our operation to the next generation. Links in the description, check it out below. Last one is probably one of the biggest things that I see people decide between these 2 products on. With LRP, you have a specific head count that you can insure. That means if you want to put LRP on 3 head right there, you can. With put options, you have to utilize the 40,000 pound for fat cattle and 50,000 pound contracts for feeder cattle. Now, if you have a bigger herd size, or if you have maybe more of a feedlot setting and you're kind of going through bigger numbers, it might be less of a factor. But for a smaller operation, sometimes they look at LRP and they just like the fact that they can get that thing narrowed down to the specific head count. It's probably going to be a bigger factor if you, let's say you have, less than 10 head. That's LRP is probably going to be more realistic, because if you put on a put option, you're kind of speculating with the over-hedged amount. So you are actually over-hedging when you purchase a put contract if you have, less than 10 head. And for some people, that's a game changer. Are you truly hedging if you were speculating with a little bit extra? Probably not. But for some people, it doesn't matter. For some people, it does. Both of these products can work, and I don't think that both of these products are right every single year. I think that you should understand these products, learn them, so that you have them as tools at your disposal. Make sure you understand these products. If you want to go to a commodity broker and ask them, that's great. But I created the Agri Summit community so that you can learn these things ahead of time, so that you know that your commodity broker is not trying to sell you on wasted commission. And the same is true for LRP. If you had one of those people come out, sell you LRP early in the beginning, I understand. I get it. There was a lot of people selling LRP who didn't understand it. They were literally selling a product that they didn't understand themselves. And because of that, they collected their premium, they were happy, and a lot of people lost a lot of money because the cattle market kept going up and they thought they were gonna make big bucks on this thing, and it didn't really pay out. If you want more videos on topics like this, let me know in the comments. I'd appreciate the subscribe, share with 10 friends. I'll see you in the next one. God bless.